Audi has just made a major announcement that is rippling through the automotive and investing worlds. It is suspending vehicle imports to the United States, effective immediately. This decision comes in direct response to the 25% tariff on foreign-made vehicles introduced under Donald Trump's newly announced Liberation Day trade policy. And while the news may seem isolated, it could mark the beginning of a larger structural shift in global automotive trade, with Volkswagen Group, Audi's parent company, caught squarely in the crossfire. So what exactly is happening, and why does it matter? On April 2, 2025, Donald Trump's administration introduced sweeping tariffs on imported goods, including a blanket 25% tariff on all foreign-made automobiles. While some US-based automakers applauded the move, European and Asian automakers immediately began sounding alarms. Audi, which sells tens of thousands of vehicles annually to US consumers, has now responded by halting all shipments of cars into the American market, at least temporarily. According to reporting from Reuters and multiple auto industry sources, Audi has issued a directive to hold all vehicles that have arrived at US ports since April 2, and has instructed US dealers to sell down existing inventory rather than expect new shipments. The impact of this decision is already being felt at the dealership level. Models like the Audi Q5, the brand's best-selling SUV in America, which is built in Mexico, will not be replenished for the foreseeable future. European-manufactured models such as the A4, A6, and Q7 are also included in the import halt. At the time of the announcement, Audi dealers reportedly had around 37,000 vehicles in stock across the United States, roughly 2 months' worth of supply at current sales rates. That gives the company a bit of breathing room, but not much. If this issue is not resolved quickly, Audi risks losing US market share, weakening brand loyalty, and facing the costly challenge of reconfiguring its supply chain or pricing structure to account for the new 25% surcharge. Volkswagen Group, which owns Audi, is not taking this lightly. The company is reportedly assessing options, including lobbying for exemptions, fast-tracking North American manufacturing, or possibly shifting certain production to regions unaffected by the tariffs. However, none of these solutions can be implemented overnight. From an investor perspective, the implications are also serious. Volkswagen AG stock, trading under the ticker symbol VOW on the Frankfurt Stock Exchange, has seen continued weakness in the wake of the tariff news. On April 7, Volkswagen shares closed at €88.10, down 2.22% on the day. This marks the 8th down day in the last 10 trading sessions, and represents a decline of over 15% during that span. For a company of Volkswagen's size and global reach, that's a substantial move, and it's being driven by fears that tariff exposure will materially impact revenue, margins, and market competitiveness. In technical terms, Volkswagen stock is currently trading below both its 50-day and 200-day moving averages, and recent chart behavior has been decisively bearish. Investor sentiment, already weakened by EV margin pressures and global economic uncertainty, has only deteriorated further. If the share price breaks below key support levels around the €85 mark, analysts may start forecasting additional downside risk. So what does this all mean? First, it highlights the vulnerability of global supply chains, especially in the automotive industry. Companies like Audi and Volkswagen have long relied on optimized manufacturing networks spread across multiple continents. Vehicles are designed in Germany, assembled in Mexico, and sold in the United States. But when tariffs disrupt that flow, the costs rise, and decisions must be made quickly. Second, it raises real questions about the future of European car brands in the US market. Audi is just the first domino to fall. Other companies, like BMW, Mercedes-Benz, and Volvo, also produce vehicles in Europe or other non-US locations. They may be forced to make similar decisions, especially if consumer demand softens due to price hikes resulting from the tariffs. Third, this announcement marks yet another challenge for Volkswagen Group. The company is already navigating the complex and capital-intensive shift to electric vehicles. While it has made progress with platforms like the ID.4 and Audi's e-tron line, profitability has been a concern, particularly in the face of strong competition from Tesla and Chinese automakers like BYD. Add a major trade barrier to the mix, and the pressure increases substantially. It's worth noting that Volkswagen has significant manufacturing capacity in the US, most notably through its plant in Chattanooga, Tennessee. But that facility currently produces a limited selection of vehicles and can't quickly replace the high-volume imports Audi sends from Mexico and Europe. Building new facilities or expanding current ones would take years and billions in investment. In the short term, there are no easy fixes. In terms of consumer impact, we're likely to see price increases on Audi vehicles as the company determines whether to eat the cost of tariffs or pass them on to buyers. Either way, this creates uncertainty in showrooms and opens the door for competitors to capitalize, especially brands with a stronger domestic manufacturing footprint, like Tesla, Ford, or General Motors. It also introduces the possibility of longer-term erosion in brand loyalty. Audi's US market has been cultivated over decades, with vehicles that appeal to luxury buyers looking for a European driving experience. If those vehicles become more expensive, or harder to find, some buyers may move to other options and never return. That kind of shift, while slow at first, can be devastating to a brand's long-term market share. From a macroeconomic perspective, this development underscores how tariffs, while framed as tools of protectionism, often carry unintended consequences. The idea behind Liberation Day was to reduce reliance on foreign production and boost American jobs. But in practice, it may simply limit consumer choice, drive up prices, and damage relations with key trading partners. So, what should investors take away from all of this? If you're holding Volkswagen stock, or considering a position, this news should not be taken lightly. The company is facing a perfect storm of headwinds: transition to EVs, stiff global competition, a softening European economy, and now trade war dynamics. The 15% drop in share price over the past 2 weeks reflects these concerns, and could continue unless clear signs of resolution emerge. That said, for long-term investors, this could also represent a potential entry point. Volkswagen is one of the most established automakers in the world, with valuable brands, deep infrastructure, and a significant global footprint. If the company can weather this storm and adapt effectively to the changing trade environment, it may ultimately come out stronger, especially if US tariffs are eventually scaled back or negotiated. In the meantime, this story remains fluid. Audi's decision to halt imports could be temporary, or it could be the beginning of a much larger shift in how European automakers approach the US market. And that means investors, analysts, and consumers alike need to keep a close eye on both Washington and Wolfsburg in the weeks ahead. This isn't financial advice, just a reminder that behind every chart movement, every headline, and every policy decision, there are real strategic pivots happening in boardrooms around the world. And right now, the spotlight is on Audi, Volkswagen, and the fragile bridge between the US and European auto industries. Thanks for listening.